The 8th learning objective is to account for the income tax of a corporation. Corporations pay income tax just as individuals do, but not at the same rates. At this writing, the federal tax rate on most corporate income is 35%. Most states also levy a corporate income tax, so most corporations pay a combined federal and state income tax rate of approximately 40%. These calculations are simplified as income tax expense equals income before taxes from the income statement times the income tax rate. And income tax payable is the taxable income from the tax return times the income tax rate. The income statement and the income tax return are entirely separate documents. For most companies, income tax expense and income tax payable differ. The most important difference occurs when a corporation uses straight-line depreciation for the income statement and accelerated depreciation for the tax return to save tax dollars. Assume before income tax of $33 million, this comes from the income statement which is not presented here. Taxable income of $20 million, this comes from the tax return which is not presented here. A company will record tax for 2014 as follows. Assume an income tax rate of 40%. Income tax expense, which is $33 million times 40%, which is $13,200,000. Income tax payable, $20 million times 40%, which is $8 million. And deferred tax liability, which is $5,200,000. The company will pay $8 million of income tax payable to the IRS and the applicable states within a few months. The difference between income tax expense and income tax payable is the deferred tax liability of $5,200,000. It is a liability because income tax expense, which is the amount of expense incurred in 2014, is greater than income tax payable, the amount it has to pay to the IRS when it files its 2014 return. It is deferred because the company will have to pay the $5,200,000 difference in future years on its tax return. The deferred tax liability account is a long-term because it is related to a long-term depreciable asset. Chapter 12 Summary. Corporations have advantages and disadvantages. A corporation's bylaws state how many shares it is authorized to issue. Shares may be issued electronically or traditionally on paper. Stock types include common and preferred, par and no par. Attributes such as voting rights, dividend proportionate to ownership percentage, liquidation preferences, and the right to maintain the same percentage of ownership preemption may apply. All these factors, as well as others, affect the risk inherent in the stock. Companies may issue their stock in exchange for cash or other assets. The issuance entry always involves a credit to the stock account, whether common or preferred. The amount credited to the stock account depends on whether the stock is par value stock or no par value stock. If the stock has a par value, the number of shares issued multiplied by the par value is recorded in then stock account. The premium received, if any, is credited to paid-in capital in excess of par. If the stock has no par, then the total amount received goes to the stock account. Stockholders' equity always lists paid-in capital first, and within that listing, preferred stock amounts are listed before common stock amounts. The steps of the closing process are the same as those you learned in Chapter 4. Net income increases retained earnings. Net loss decreases retained earnings. Once dividends are declared, there are no obligation or liability of the corporation. Preferred dividends are fixed and based on a stated percentage of par value or a flat dollar amount. Preferred dividends, if cumulative, must be paid in full before any dividends can be paid to common stockholders. Market value is the value for which a person can buy or sell a stock on the open market. Liquidation value is the value a preferred shareholder will receive if the corporation goes out of business. Book value per share is the net equity divided between the outstanding preferred and common shares. Return on assets and return on equity ratios are both measures of how a company is performing. Return on assets measures earnings based on average total assets employed. Return on equity measures earnings for the common stockholders based on average common equity invested. Income tax payable is based on the tax return filed with the IRS. Income tax expense is based on earnings reported on the income statement. Because of different choices a company can make for its tax return versus its GAAP-based financial statements, these earnings numbers are usually different. The difference between income tax expense and income tax payable is either a deferred tax asset or liability.